Whether you're a seasoned trader or just starting out, understanding the stock order types such as limit orders, market orders, and stop orders is crucial for making informed investment decisions. In this video, we'll explain these order types in detail and show you how they work in real-world scenarios. We'll also share some tips and strategies for choosing the right order type for your specific investment goals. By the end of this video, you'll have a solid understanding of stock order types and be ready to start making smarter, more informed decisions. Welcome to Knowledge Pilot. When it comes to investing in the stock market, one of the most important steps is placing an order to buy or sell a security. However, for novice investors, this process can be quite daunting, as they may not fully understand the various order types available to them. To ensure a successful trade, it's important to select the appropriate order type based on your investment objectives, market condition, and risk tolerance. In simple terms, order types are instructions given to your broker on how to execute your trade. They dictate the specifics of the transaction, such as the price at which you want to buy or sell the security, the timing of the trade, and any conditions that must be met before the trade can take place. To place an order, you'll need to open an account with a brokerage firm that provides online trading services. Once you've selected the security you want to invest in and determined the number of shares you wish to purchase, you can then choose from various order types. The three most common order types are market orders, limit orders, and stop orders. First up, how an order is placed. After deciding to buy or sell a security, your order is sent to your broker, who will attempt to execute the order in the market. However, due to the constantly fluctuating prices and complex order routing system, the speed and price at which your order is filled can be impacted by numerous factors. To optimize the execution of your trade, it's essential to choose the right order type. Understanding the different order types available can have a significant impact on the success of your trade. Let's begin by exploring the market order. The market order. It's important to note that the speed and execution quality of your trade can also be affected by the routing system used by your broker. Depending on the order routing system, your order may be filled more quickly or slowly, and at a better or worse price. Therefore, it's crucial to select a broker with a reliable and efficient routing system to optimize the execution of your trades. Investors who use market orders usually care more about how quickly a trade is made than how much it costs. Since there are no price limits, this type of order has the best chance of being filled quickly, but it could be at a slightly different price. For example, let's say an investor puts in an order to sell a stock at $75, but if the price is falling and other investors are also trying to sell, the price could drop before the order is filled. Also, if an investor puts in a market order after hours, the price could be very different when the order is filled when the market opens the next day. If this is the case, investors usually use market orders during trading hours and in markets with a lot of trading activity. This makes it more likely that an order will be filled at a price close to what was asked for. You might want to use a limit order instead of a market order if you want to buy or sell at an exact price or better. Limit orders. With a limit order, you choose a price and the order won't be filled until the stock can be bought or sold at that price or lower. Due to the price limit, however, there's no guarantee that the order will be filled quickly or at all. Limit orders are most often used by investors who know what price they want to buy or sell at and are willing to wait for the market to move in their favor. Say for example that a stock is selling for $55 right now, but an investor thinks it would be a good deal at $50 or less. This investor could put in a limit order to buy the stock at $50. If the stock price never gets to the limit price, the order will never be filled. If the stock does drop to $50 or less, and there are enough shares available at that price, the order will be filled, and the investor will buy the stock for $50 or less. Stop orders. The last type of order is a stop order, which is just a market or limit order with a trigger price that tells the order to go into effect. When the stock hits the activation price, the order is carried out based on the type of order it is. There are many ways to use a stop order. When securities reach the activation price, investors can use buy stop orders to buy them, or they can use sell stop orders to try to limit the amount an investment could lose. For example, an investor might put a sell stop order on a stock they own, telling the market that they want to sell the stock at the next available market price if the stock falls below a certain price. This could help you avoid bigger losses by getting out of the stock before it falls too far. Stop orders come in three different kinds: stop market, stop limit, and trailing stop. Stop market order. If the investor in this example uses a stop market order, the stock will be sold at the next available price if the trigger price or a lower price is reached. The benefit is that a stock market order can help the investor quickly get out of a position that is going down. But the risk is that the next price available could be lower than what the investor expected. Stop limit order. However, if the investor uses a stop limit order, when the stock falls to the stop price, it will trigger an order to fill at the limit price or better. Being able to decide how much the stock is sold for could be a benefit. But there is also a chance that the stock will fall so quickly that the stop will be triggered. But the limit order will never be filled because the stock has fallen below the limit price. This is where a trailing stop order could be used. Trailing stop order. With a trailing stop order, you don't set a specific price for when the order goes into effect. Instead, you set a trailing amount, which is a certain dollar amount or percentage away from the market price. Setting a trailing stop below the market price on a long position is a common way to try to lock in profits as the stock goes up. So let's say you own a $100 stock and set a trailing stop order at $5 below the current price. If the price of the stock goes up to $110, the stop price will go up from $95 to $105, which is still $5 below the market price. But if the stock started going down, the trailing price would stay at $105, which would limit how much you could lose on the position. There are pros and cons to each type of order. Investors should think ahead and figure out what kind of order is best for each situation. It can be hard to remember which order to use. Before putting real money on the line, you might want to practice each type in a paper trading environment. Remember that placing an order is a crucial step when investing, and selecting the appropriate order type can make a significant impact on the success of your trade. Market orders, limit orders, and stop orders are the three most common types of orders that investors can use, depending on their investment objectives, market conditions, and risk tolerance. Always remember to choose a reliable and efficient broker with a good order routing system to optimize the execution of your trades. We're going to wrap things up here for today. We hope you liked this video. If you want more information on stock order types, limit orders, market orders, and stop orders, check out our other videos on the screen. Thank you for watching.